Vanguard getting into private equity. Why?
So if you look at Vanguard's traditional products, there's really a race to the bottom in terms of fees. Private equity does tend to have higher fees, and not to mention there are fewer public companies out in public markets these days. So it makes sense for BlackRock and Vanguard to want to have these longer-term investments in private markets where returns over the longer term have been higher than public market returns.
So is the idea here people think that Vanguard's going to pressure private equity fees lower, or is there some other kind of purpose here for Vanguard?
Listen, there is a belief. This is not Vanguard didn't get in to push the fees lower. Is that a repercussion of what may happen here? Absolutely, because Vanguard is the world's second largest asset manager. The way they structured this deal is through a private equity fund of funds. Lisa, I think another big question here is what kinds of fees are pouring into their consumer? Because you're paying Vanguard, then you're paying the private equity fund of funds, and then you're paying the private equity firm that they're invested in. So whether their clients are happy with the returns net of those fees is going to be the $100 question in the room.
Yeah, there's also questions about retail investors and whether Vanguard will open up to that. Sonali, I'm sure you'll be covering all of that. Meanwhile, Brookfield just raised the second biggest infrastructure fund ever, exceeding even the firm's own fundraising goal. John, do we have any idea how they plan to deploy this cash?
Yeah, well, a lot of it is internationally, outside the United States, and it's on projects like pipelines, railroads, and technology infrastructure, too. There are a lot of private opportunities that are essentially like the equivalent of toll roads where they can be collecting steady fees for building these projects.
So, John, there's been so much fundraising recently for infrastructure funds. Do we know where the interest is coming from right now?
Well, interest is coming from institutional investors with long-term horizons who are seeking higher yield. I mean, infrastructure investment is kind of like a bond. It's actually almost like a floating rate bond if they can keep raising the charges on the toll road or whatever the infrastructure asset is over the long term. And a lot of these big pension funds, for example, need to think 40, 50 years in the future, which is what these projects are great for.
Do we have a sense there's a record amount of dry powder in some of these funds right now? Is it because they can't deploy their cash, there aren't enough opportunities, or is it because they're just raising money so quickly?
I think it's a combination of the two. I mean, a lot of people want to get in there. Last year, according to Preqin, infrastructure funds averaged 8.6%, which is pretty good compared to other fixed income investments. But in the U.S., we got like $2 trillion in infrastructure needs. However, the federal government hasn't really gotten its act together like other countries. The U.S. is the biggest potential market out there, and it hasn't really materialized for a lot of these infrastructure investors.
All right, there's also a lot of interest in leveraged loans recently, in particular collateralized loan obligations. Apollo Credit Management just pricing one of the largest CLOs since the crisis. Lisa, how much has demand picked up for this market?
It's definitely risk on back in the CLO market. Last year, investors were worried about a credit downturn, but that fear has gone away with the economy picking up. And so especially the demand for AAAs from banks and insurance companies and for the shorter dated paper from the mutual funds have really picked up CLO supply and demand.
So how much is CLO issuance kind of rushing to meet the increase in demand here?
Well, it takes a little time to get these vehicles together. So last month, you didn't see that many new issuance, but already we have about $5 billion in the pipeline, and also refinancings and resets are picking up. So there's a lot of CLO managers trying to rush on and meet the demand.
Lisa, last week, the Federal Reserve came out and said that it was going to include leveraged loans more strenuously in stress tests. Leveraged loans obviously underpinning CLOs. I'm wondering how significantly this will affect the market, if at all. How serious is this substantial regulatory push?
Well, I do think it will allay some fears. Regulators have highlighted leveraged loans and CLO as a systemic and as an economic risk. I don't think there's many people who think that would be a very strenuous or a different outcome that most banks will pass. Banks, for the most part, have different areas of risk. It's when they underwrite loans, also warehouse CLOs, and also many banks buy AAA CLO. But I think most market participants feel like banks have managed it fairly well. And so this market stress test perhaps will allay fears, but won't really change any dynamic one way or the other.